Interbank lending markets and repurchase agreements. Banks have to lend money in accordance with the amount of reserve that they have on hand. However, there is no way of finding out the exact amount of loans that a bank can give out while still complying with the reserve requirements because taking deposits and making loans happen simultaneously. Therefore, it is impossible to maintain an exact percentage between two dynamically changing numbers. This is because reserve requirements are calculated as a percentage of their demand deposits. Demand deposits are by definition random. Also, banks do not wait to first get all their deposits to make their loans. This would not be feasible. In reality, banks make loans and accept deposits simultaneously. Hence, it is possible that an individual bank may make more or less loan than they should have. For instance, consider that a bank realizes that it has made so many loans that it now has only 9% of its deposit held as reserves, whereas the required rate is 10%, whereas another bank realized that it is left with 11% of its deposit as reserve, when the required rate is only 10%. To help banks transfer the surplus and deficit amongst one another, interbank lending market exists. The system as a whole always balances. To understand why interbank lending is important, one must first understand the nature of the banking system. The banking world functions as one united system. Therefore, an individual bank may possibly make excessive loans as compared to the amount it has on deposit. On the other hand, an individual bank may possibly make fewer loans than it should have made. However, the system as a whole would have made the exact amount of loans as prescribed by the reserve requirement percentage. Hence, the excess reserve held by one bank can be used by another banks to offset their deficient reserve requirements. This will ensure that the system always balances as a whole. To facilitate this transfer of funds between banks, interbank lending markets are required. Holding excess reserve is pointless. Another point to be noted is that it is not the best interest of the banks to hold on to additional reserve. This is because they do not get paid interest for parking their funds with the Fed. Hence, banks want to minimize the amount that they keep with the Fed. Hence, if the reserve requirement is 10%, every bank wants to maintain exactly 10% with the Fed and not a penny more. Thus, the interbank lending market always finds willing parties on both sides. Borrowers are willing because the system mandates their willingness, whereas lenders have a financial motive to not hold on to the excess fund that they have. What are interbank markets? Interbank markets, as the name suggests, are markets where banks deal with other banks. The amount of money that is being borrowed in this market is huge. Also, the sole purpose of borrowing in such markets is to meet the statutory reserve requirements that have been set by the central bank. Apart from the loans being of huge amount, they are generally offered without any collateral and for an extremely short duration of time. The average interbank loan is for overnight purposes. Loans of more than 1 week are unheard of the interbank markets. These markets provide banks with the liquidity required to make loans without being constantly worried about deposits. In case they fall short on deposits, they can always borrow them. Thus, the interbank enabled the functioning of the entire market as a well-oiled machine. Repurchase agreements. Repurchase agreements are an alternative to borrowing in the interbank markets. When banks do not want to borrow from each other, they can also borrow from the central bank. In such cases, the central bank usually lends money via a repurchase agreement or a repo. Thank you.